G'day everybody, my name is Sam Tabbert. Welcome to Bamboo Wealth Financial Planning Does Matter. Today we're going to talk about superannuation, early access to superannuation, which was introduced by the government this year as a result of the coronavirus. Some very important things to consider before taking out your superannuation. Now, there obviously are very extenuating circumstances where you need to take out money to provide for your family and your lifestyle. The important thing, as of 23rd of March, the Omnibus and the associated bills was passed, which means effectively you're able to take out superannuation up to $10,000 before June 2020 and after July 2020 up until approximately September 2020. Now, so far the ATO has actually received approximately 800,000 applications, and the superannuation industry expects to also receive up to 1.6 or 1.7 applications to make withdrawals from superannuation. Now, the other thing too is that this will probably add up to about $27 billion worth of withdrawal on superannuation. Some of the things to bear in mind: first of all, eligibility. Anyone who has been made redundant from January this year, has lost their job, or has their income reduced by 20%, or if you are a self-employed, your turnover has been reduced by 20%, you are eligible to apply for early access of your superannuation up to $10,000 this financial year. Now, the other thing to remember too is this is as of 20th of April this year. And so how can you access your money? Now, it has to be done through the ATO or through MyGov. So if you haven't set up a MyGov account, you can do this by going on to my.gov.au and follow the instructions. You're able to set up as probably within 5 minutes. The other important thing to remember too is that you cannot do this through your superannuation fund. It has to be done through the government or MyGov. And generally, once you apply, you'll get a response within 2 to 3 days, and applications generally take up to 5 days. Now, obviously, in the current environment with a high turnover and also request, this could go a bit further. The other thing to remember too, if you have a transition to retirement, you can't withdraw money from a transition to retirement. You have to convert your income stream back to superannuation to be able to make the withdrawal. The thing to consider too, when you're making a withdrawal request, to ensure that you make the full amount that you require for the first withdrawal, because the ATO only allows you up to one withdrawal per financial year. So you can make withdrawals across a number of funds. So if you have 2 or 3 funds, you can make up to a maximum of $10,000 across those 3 funds. But let's say, for example, you make one withdrawal only up to $5,000, but then you realize you need more money. The ATO at this stage is only allowing you to make one withdrawal. Now, what do you actually need to consider? This is extremely important in terms of taking money out of your superannuation. Remembering superannuation is a long-term investment vehicle. It is tax effective. It's taxed at 15 cents on the dollar. Hence why it allows you to build your retirement fund at a much quicker compounding rate, because you're only paying 50 cents on the dollar. Now, any withdrawal that you make as a result of this new legislation is non-assessable and non-exempt, which means it is actually tax-free. The other thing to remember too is that with Centrelink, it does not have an impact on your income, or as it says, if you're actually currently on Centrelink benefits. Now, the other thing I wanted to also highlight, that when you consider that you can take $20,000 over, say 2 to 3 months, most Australians, about 55% of Australians, have less than $25,000 in their superannuation. So there are some consequences, and one of the significant consequences to bear in mind is that if you take out money now, you can actually reduce your superannuation to 0. Now, if you do that, most people who are the employer effectively pays for their insurances. You may lose your insurance cover. Now, most policies will have either a life insurance, a total permanent disability insurance, or income protection as a default when you join a new employer. If you draw down your superannuation and it's equals 20,000 and your balance goes to 0, you'd basically have to wait potentially up to 2 to 3 years before you're able to actually build up enough money to be able to accumulate more wealth and be able to reinstate your insurance policies. So this is very important consideration. So this is part of the legislation that was introduced this year, which is putting members first. And it basically protects members who've got less than $6,000. So until you got $6,000, then effectively you need to obviously have enough money to have insurances paid to or given to you automatically. The other thing to remember too, that with superannuation, it is a retirement savings vehicle. By taking money out of superannuation, there may be significant impacts, even though you might have a larger balance. Just as a rough figure, based on an assumed rate of return and also inflation. Now, if you're at the age of 20 years old, by taking that $10,000–$20,000 from your superannuation can mean that you've essentially foregone loss of future growth in your retirement by about $300,000. If you are in the age of 30, this could actually equate to a loss of about $137,000 and build up retirement benefits. And if you are at the age of 40, this can actually relate to about $38,000. So there are some important things to consider. The other important thing to bear in mind today is that the share market has taken a significant fall in March, approximately about 37%. Most share funds or every unit kind of balance funds, your balance would have come down by about 20%. So it's very important to realise that if you're taking the money out of superannuation now, you are withdrawing your funds at the lowest point of your portfolio balance, or one of the lowest points. So sometimes it's important to, unless you absolutely need to take money from superannuation, you leave money inside super, because as we mentioned earlier, with the compounding effect of low tax environment, your superannuation will grow at a much greater rate. Now, these are the most important things that you should be considering. Speak to your financial advisor. Come see us. We're able to give you an analysis on how this will affect on you by taking that $20,000 within the next 2 to 3 months. Now, of course, as we said, we have unprecedented financial, economic, and family and lifestyle consequences on our lives. So if the money is needed, you can apply through the tax office under compassionate grounds to take $20,000. If the money is not needed, it is always worthwhile to leave the money in there for the long term, so you can enjoy a more comfortable lifestyle. So I hope that gives you a bit of a rundown about the importance of taking your superannuation under the current legislation. If you have any questions, please contact us on 1-800-855-014, and hopefully you're able to continue building your wealth, but at the same time, please look after yourself, your family, and also, most importantly, your health in the current environment. And that's it for today. We'll speak to you next time. Thank you.